Good morning, ladies and gentlemen. We have about 2 minutes until we start. 2 minutes and counting. Good morning, Checkmate crew. Today is Thursday, December 8th, 2022. It's 30 minutes after the opening bell of the New York Stock Exchange. It's yours truly, Mickey Blindside, here with your market memo. Okay, let's go ahead and get right to it. So today, we are seeing a little bit of a rally in U.S. equities. Okay. Let's just take a look at what's going on here. So SPX, I think we're up a little bit today. Yeah, we're up a little bit less than, a little bit over 0.75%. We are seeing the VIX pretty much around flat. All right, so we've kind of been expecting this. Remember, guys, the thesis from this summer. Okay, and I've said this multiple times, even this week. We're seeing these outsized moves in the VIX. Okay, we've kind of anticipated this. We remember in the summer we had this dash for cash. All right, nobody was hedging. The VIX was going down while the market was going down at the same time. And you know, our reasoning at the time was instead of holding shares and hedging with puts, which causes this VIX spike to cause the markets to come down. We're seeing this we saw this phenomenon over the summer where a lot of institutional investors actually cashed out because there was no more TINA. There is no alternative. There is an alternative when the dollar is trending up and when interest rates are high. You can sell your shares, take that cash, park it, and get your 4% in a 2-year treasury or a 6-month treasury. So we actually saw a viable alternative to holding risk assets, which we have not seen for the past decade. All right. Now, I think we're seeing hedging demand coming back. We're actually seeing the VIX going up, making outsized moves. Remember, the VIX was up like 6-7%, but the market was down like 1.6%. Those are big VIX moves for somewhat smaller moves in the indices. And remember I said, as we see this hedging demand come back, we could be seeing the setup for a rolling bull market. And I told you this is not the end. That doesn't mean it's the end of the longer term secular bear market. It just means that we're going to have a little bit of this mini bull market in between this secular bear market. Okay, so I do think and that mini bull market can last for a couple of months, and we've seen this time and time through. If you look past that other, if you look at past the bear markets, this is a common occurrence. I always allude to the 70s. You've probably heard me, talking about the 70s for months now. If you go back, there was like multiple mini bull markets in that decade-long bear market that we had. So not so far-fetched, really. But anyway, we're starting to see that the VIX is making outsized moves. I do think that at some point we're going to see this rolling bull market that can last a couple of months, sometime probably in 2023. Everybody's expecting this recession and market crash in the first half of 2023. I don't think so. There's no data that really suggests that. I mean, could it happen? It could. If we have like a risk event or something like that, it could happen. But there's no data to suggest that there's something that's going to happen in the first half of 2023. There's data to suggest that at the end of 2023, beginning of 2024, that we might see something. And you guys know my thesis on that, with the emerging market solvency crisis with inflation roaring back at the same time. I think that's going to be kind of a confluence of pressures on the economy. Also at that point too, as the inflation goes up, most likely there's going to be a fiscal cliff. They're probably going to have to raise taxes and lower spending, and that's going to put a drag on the economy as well too. So I think that's more toward end of 2023, early 2024 when that happens. But in between then and now, we could see this rolling kind of bull market, which I fully intend to take advantage of. So that is what I'm looking out for right now. The VIX flat, actually up 0.01, so basically flat, but the S&P 500 is up 0.8%. Very interesting. Now, some of you guys are, I get it. Patience is a very difficult virtue to work with. I myself have issues when it comes to patience. It's something that every trader has to really work through. Let's take a look at this. Now, some of you guys are already getting involved in some tech stocks and getting long. I saw some people talking about Uber. I saw some people talking about TQQQ, the triple leveraged QQQ. Here is what I'm looking at right now, okay? And here's the reason why I'm still kind of I'm still kind of skeptical when it comes to tech stocks here. If you actually if you actually look at the IVW IVE chart, okay, that's the IVW IVE. This is our growth to value, all right? Growth to value. Growth to value right now is suggesting that value is going to outperform at least on the short term. And when this growth to value chart is trending down, that means value is outperforming growth, all right? Until I see this trend change, it's going to, the more investors, more institutions are going to be focusing on value names than they are going to be on growth, all right? And so I just don't see that. Where do you see this going up? Now, if this were in an uptrend, or, if we were here, different story, or here, in 2020, that huge outperformance in tech over value names. You want this chart to be trending up if you're in tech right now, but that's not the case. So even if you are going to play this mini bull market, until we see this trending up, it's not going to be in tech. I think the advantage, if you're going to go long, is going to be in value. I actually think certain value plays like individual stocks. This favors more picking individual stocks rather than with high quality, rather than going with like a growth index or something like that. And so again, this is the reason why the institutions are favoring value right now over growth. So why are you fighting the market? I mean, I get it. If you're in TQQQ or if you're in tech stocks, You're probably thinking, oh, this is going to curve up and we're going to see this episode of growth versus value. Well, we'll see if that happens. But, you know, so far, do you see any confirmation of that yourself from looking at this chart? I mean, I don't. So, but that's just my opinion. You know, you don't have to follow anything I say, of course. None of this is financial advice, but still, you know, the data is the data, you know, and this is trending down. If this is trending down, value is going to outperform. So why fight the market? That's just my piece. All right. We'll see what happens. But you know, we are slowly getting long on certain names. You know, we've talked about this before. FLNG, I'm trying to get into. I'm in MATX or MATSN. Actually, what is MATSN doing right now? Oh, it's up today. Very good. Very good. Nice. All right. So it's bouncing off of that level. Yeah. And so, you know, we're slowly accumulating certain names, right? PPC, for example. All right, this is the name that we've been accumulating. We're about to sell some premium against this. You know, companies that are making money. All right, and are more of a value play. They have more current earnings. So that's really what I'm looking for right now, as far as names to get into. I want EPS growth. Those are the types of names. I don't want to be looking at the potential of future earnings. All right. And that's, you know, that's the definition of, you know, what growth stocks are. You know, those are more priced for future potential than current earnings. Okay. But still, in this environment, I still think a bird in hand is worth more than two in the bush. All right. So we are looking for companies that are more, that have more of a value component to it. So next, I also wanted to discuss energy. I know a lot of you guys are trying to get into energy names. Energy has been a great place to get value stocks for the year. Let's look at oil prices. This is a yearly chart. Okay, so each candle is a year. We are now negative for the year on the price of WTI crude oil. Okay, we are now negative. Who would have thought? Who would have thought in the beginning of the year that we'd go negative on the price of oil? We're now negative on the price of oil. Okay, this is we had some huge sell-offs. I mean, huge sell-offs in oil price in last few sessions. It looks like it is trying to recover. We'll see what happens. You know, is it possible that we see lower? It could be. There's a big meeting coming out in the beginning of January for OPEC, you know, the oil producing countries. They're going to have this big meeting in January. I suspect that we're going to see a lot more oil volatility as we get closer to that. That's only like a few weeks away. So we'll see what happens. I think it's the first week of January. I'm definitely going to be paying attention to that, and I think oil will make a move based on that. Broad commodities have been going down with energy. A lot of the grains and food commodities have been going down as well too. The reason why I bring this up is because TIP TLT, which is our forward-looking inflation indicator. TIP TLT. TIP is the inflation protected treasury ETF. TLT is the longer maturity bond, longer maturity treasury ETF. When you divide those two, okay, when you divide TIP by TLT, you get this ratio, and this is the forward-looking indicator. This is what the bond market is saying about inflation going forward. When it's up, that means the bond market is pricing in higher inflation, and it's coming down. Bond market is pricing in lower inflation, possibly deflation. Okay, now this has been a very accurate indicator of ours right here. When it peaked out in May and in June, this is where we anticipated that we were going to see lower than expected CPI numbers. Lo and behold, last month we had that lower print. How did we get that, right? It was because of this. Now, you may be at, and now remember, also about a month or two ago, I said that the price action here on TIP TLT was probably an anomaly because of the final 9+% inflation protected bond issuing to the public. And so there was this huge bid from the public to get into those final 9+% inflation protected bond yields. And I think it caused a little bit of an anomaly that lasted for like a few weeks. We're back down into that box. Remember that box we were talking about? This is a box we've been talking about for almost like half the year, okay? We're back in there. We're actually in the lower end of that box, all right? And so I do think, with the commodity prices coming down like this, we saw this TIP TLT ratio really drop. And this is actually a tradable ratio. There's a lot of institutions that actually trade this, okay, the TIP TLT. This actually requires a lot of capital, so usually your bigger institutions are the ones that take this trade, but they do take this trade to hedge inflation or to hedge for deflation. This is a very popular trade amongst big institutional players, okay? I do know that, when I was in the industry, this is something that was regularly traded all the time, this ratio, okay? And so this coming down really shows that the market is really pricing in a little bit of a lower inflation, possibly deflation going forward, at least for the next few months. We shall see. I mean, it's in that box, okay? So let's just erase this, the anomaly, and let's just think about this. I mean, it's still pretty much in the box. Okay, is it going to make, I do think though, and this is something that we talked about in the summer, I do think we stay in this box, okay, minus this anomaly, of course. Again, that's a one-time thing where this 9+% inflation protected bond, it wasn't going to be 9+% going forward. So the public just bid up that inflation protected treasury. But outside of that anomaly, we're in this box, okay? I think we're going to stay in this box until about Q1 2023, and I think it's going to go back up again. I think inflation comes back. Okay, I'm not trying to predict the future, but I'm just trying to anticipate what could happen. I think that's what happens. We stay in this box, we chop around here, and then we start curling up after Q1, possibly Q2 2023, okay? Then we'll see what happens. After that, I have no idea, okay? But we'll see what happens. But I think that's worth noting. When we saw commodity prices really drop, we also saw TIP, TLT really drop too. So we might see some lower inflation prints for the first half of 2023, which kind of makes sense because if you look at the CME futures, the probabilities for the Fed funds rates, I mean, the next one is, the December one is pricing in a 50 basis point rate hike. The next one after that is, either a 25 or 50 basis point rate hike. The odds of a 25 basis point rate hike actually have been increasing for the past month. So already the market is pricing in slower rate hikes. The bond market is already, the bond futures market is already pricing that in. And then, it looks like it's peaking out at around 5.25 or so. All right. And we're going to be there for a bit. And then you see the potential for a rate cut at the end of 2023. Okay, so already we're seeing this, that with TIP TLT coming down, bond market is already pricing in rate cuts, and this is something we anticipated back in September as well too. So I think, and this is why inflation is a sticky problem, because once CPI starts coming down, there's a lot of pressure on the Fed to ease on tightening. A lot of politicians are just lobbying. A lot of special interest groups, a lot of banks, a lot of financial institutions are lobbying right now for less tightening. Okay, and so you need somebody like Volcker who's not going to listen to that pressure. I don't think Powell is a Volcker, okay? And so this is why inflation is a sticky problem. If you look in the 70s too, it's the same thing. All the chairman of the Federal Reserve before Volcker, once they saw that CPI kind of lighten up, they would loosen up and stop the tightening, and that's what causes the next wave of inflation, okay? And that's why inflation is generally a sticky problem, and we see this kind of like quote unquote lost decade around this peak credit high inflation time period, and so again, that's a little bit down the road, but I do think that is what is at play right now, just based on the data and just based on what I'm looking at. So we'll see how we can play that. We'll take this one day at a time. But next week, FOMC, I think we're going to see a lot of volatility, either to the upside or the downside. I know that's not really saying much, but I think there's going to be some big moves. And again, yesterday we went over the SPX options chain. It's also quad witching. It's also monthly OPX. It's a pretty big one. We've got some big put walls that we're dealing with all the way up to like 4,000, even higher really. But we could see the VIX deflate rather quickly because, we are quote unquote over hedged. But if the VIX keeps going up, if the markets don't take that FOMC very well, or if Powell says something, I mean, we could see it still drop, if the VIX goes up. But the VIX is going to have to climb up. It's going to have to go to like 25, 26 to really maintain a drawdown in this market with all those shorter dated puts, which are in the December monthly OPX chain. Those shorter dated puts, if some of them get cashed, you're going to need more put buyers coming in order to elevate that VIX and make sure that the market maker is still shorting the underlying. We'll see if that type of hedging demand happens after FOMC or not. Okay. So next week is going to be a busy week. Okay. So that's the U.S. indices. When we're talking about U.S. indices, we might as well talk about our liquidity data. Our junk bonds ADL has been holding up quite well. There's actually a bullish divergence. The junk bonds ADL is actually up, but the S&P 500 is down. So if you were paying attention to this, then you would have known not to short yesterday at the bottom because usually when the liquidity is increasing, those floors and those put walls are a lot stronger. Okay, and so our junk bonds ADL is still going up, so there is a little bit of a bullish divergence in the junk bonds ADL. But there's also another divergence I want to mention, and again, we talked about this a little bit yesterday, but the junk bonds ADL is going up, but our other liquidity signals are not. If you look at the New York high-low line, the New York Stock Exchange high-low line, so the New York Stock Exchange high-low line is they take all of the stocks that are traded on the New York Stock Exchange. They measure how many are making 52-week highs and how many are making 52-week lows. They subtract that, and then if it's a positive number, so if there's more stocks making 52-week highs than are making 52-week lows, that's a positive number. It gets added to the previous day's number. And then you create this line. Okay, if there's more stocks making 52-week lows rather than 52-week highs, it's a negative number, and so then that gets subtracted from the previous day's number, and then we form a line and that goes down, right? So if it's going down, it means there's more issues, more stocks are making lows than they are making highs, and that is curling down. Since the 1960s, we have not gotten out of a bear market without this curling up. Okay, this has not curled up yet, but it's actually curling back down again. Okay, it's actually curling back down again. All right, so this is not bullish at all, and actually for today it looks like the New York high-low line is negative again. So if we close, well, we've only been open, the market has only been open for less than an hour, so who knows, right? At the end of the day, maybe we do get positive, but if we do end up being negative as well, I mean, this is going to keep curling down. All right. Also, our New York advanced decline line. This is the advanced decline line of the New York Stock Exchange traded stocks. Okay, so we have we have our own advanced decline line on junk bonds, which measures this in the junk bond market. The NYAD, the New York Advanced Decline Line, that measures the advanced decline line on the New York Stock Exchange. Okay, so it is trying to rebound, but it did make a lower low on the daily chart. So it looks like, at least on a temporary basis, breadth is decreasing, although today it is trying to make an attempt at an increase in market breadth. But we are starting to see these data divergences as well too. So I'm not surprised that we're seeing these data divergences, especially in sight of this a big binary event, actually two binary events back to back. We got the CPI report coming out on Tuesday, plus we got this FOMC on Wednesday next week. So it's going to be a big week. I'm not surprised that we're seeing these divergences. We're probably going to witness this divergence all the way through until FOMC, and then we'll see which way the data breaks. Does it is it our junk bonds ADL, or is it our New York Stock Exchange high low line? We'll see who's right. Okay, there's no need to guess. I'm just going to remain patient until we get to that point. And again, I know patience is very difficult. Speaking of a difficulty and patience, let's look at China. I mean, wow. Look at the Hang Seng Index just making a huge rally today. I mean, it's been rallying now for the past few weeks. Everybody was saying, oh, China, they're going to lock down again. Well, I guess not. I guess that was just media hype, and social media hype. But, if you look at their markets, and also if you look at the Australian dollar too, actually, let's take the Australian dollar in our on our platform here with our levels. So, again, daily and weekly closes are what's most important on currency charts. We lost this make or break level, but now we regained it. And on that regain, boom, I mean, the market's rallying hard, okay? Especially the Hang Seng rallied hard on that. Let's see here. There we go. Okay, rallied hard as I noticed that the Australian dollar overnight in our overnight market here in the U.S. Once that happened, once we saw this clear break in the Australian dollar where it was breaking to the upside, all the Chinese stocks just ran up, especially the Chinese growth stocks right now. It looks like they are reopening, and I actually read some reports from different investment banks overnight, and yeah, I mean, they're looking at easing of COVID quarantine and testing rules in Hong Kong and in other places in China as well, Beijing. They're loosening restrictions. There's senior Chinese health officials estimating that 80 to 90% of Chinese people will contract COVID in the coming years, and I think they're okay with it. I think they're realizing that they need to get herd immunity, and the only way to do that is to let people just live their lives and let the virus, just take its course. I think they're willing to accept some deaths in order to maintain economic growth, and I think it's definitely is a huge pivot from the Chinese central government, and so we are noticing that. Okay, HSI, the Hang Seng Index is rallying hard. Australian dollar also has had relative strength amongst other risk-on currencies. Compare Australian dollar to the dollar. If you compare it to all the other risk assets, there's a lot of strength in the Australian dollar. And again, we talked about the Australian dollar being a very good forward indicator for China. It has served us very well. It serves us well now. And again, the reasoning behind that is because as industrial demand, as industrial output increases in China usually gets all their raw materials, not all, but a lot of their raw materials from Australia. So when there is an expectation for increased industrial output in China, the demand for the Australian dollar goes up because the Chinese will have to buy buy Australian dollars in order to buy all their raw materials like copper, like the metals, like, you know, and all these minerals that they need for their industrial output. So that's why usually this Australian dollar is a good lie detector for what's going on in China and in those markets, okay? And so we never saw it make that like lower low and breakdown. Remember, I said if we break this level, what we're looking for is a break of around that, you know, that 0.664 or so, and it never did. It never even got to that point. It just rebounded really quickly, and now we're above that make or break. Now this line is going to come, this downtrend, this like multi-year downtrend comes into play. If we bust out of that and we really get over 0.69, I mean, it's over. The at least temporarily, the bear market in China is over. I don't think that's going to last very long. I think it's going to last like 2 or 3 quarters at the most, maybe a couple of months. But that definitely puts a tailwind on Chinese stocks. And the way we're playing it here at Checkmate, and again, you know, it's not financial advice. You can follow whatever you want. But I'm going to be going into ZTO. ZTO didn't have much of a pullback. ZTO is like the Chinese FedEx equivalent. As people go around again, and actually there's reports coming from China that already domestic traveling is increasing, domestic tourism. Domestic tourism means a lot more people going into restaurants, a lot more people buying stuff, buying merchandise, meaning there's more need for shipping. ZTO is a great play. Not only that, ZTO, the reason why I want to get into ZTO, the fundamentals, the EPS growth, the cash flow, the free cash flow. Not only that, they have a very aggressive share buyback program, which they're increasing. I mean, this is a wonderful story, guys. ZTO, I mean, this is the name to be in. Unfortunately, it's not pulling back enough for us to get into like a value zone, which is very unfortunate because I'd really like to get into this. I should have got into this here, shoulda, woulda, coulda, right? But I'm really looking for a pullback. I might have to even raise this a little bit. I may even raise it to like, you know, the buy level at 22 or so. We'll see. I think a lot of that is going to also have to do with the dollar. Let's actually take a look at the dollar as well. Dollar is actually pairing back. This is kind of the line that we were looking for as a buying point. It doesn't look so good right now for dollar longs, but I do have those dollar longs. They're acting as a hedge for all the stuff that we're buying. You know, we're in maritime shipping, we're in uranium, we're in metal mining. All of this, you know, is very sensitive to the dollar, and so that's why my position sizing, at least on the UUP, which is the dollar index ETF, on those calls, my position sizing is such that it's acting as a hedge for what I have right now. We'll see. I may add to it if I start buying like other metal names, like if there's opportunities, and if I start getting into like SILJ or, you know, silver miners, gold miners, I may increase my position just because I need to increase the value of my hedging. But outside of that, no, I'm not going to be adding more to this until, you know, especially since it doesn't, you know, right now it's kind of floundering. I mean, who knows though? I think in the next couple of weeks we can tell, especially FOMC too. If there's a spook in the FOMC or something like that, CPI data doesn't come out right or something like that, you know, we could see the dollar go up. I do think that the dollar will go up at least temporarily and make this make this lower high, at least on a daily chart, and then continue down. And, you know, and that's kind of supportive of this rolling mini bull market thesis that we have. I do think, though, at some point in the next couple of years, the dollar does make it does, you know, go higher than this year's high. I do think that's going to happen as inflation roars back and the possibility of further tightening happens down the road. But at least for this season, I think this is the high. I think it goes, the bullish case scenario here for the dollar would be for it to have a little bit of a retracement of this breakdown and just go up to like, 107 to 109-ish, and then, continue its way down at least for the next few months. I do think the dollar comes back up, especially around the second quarter or so, maybe third quarter of 2023, as there is demand for the dollar. I think the demand is going to come from emerging markets as they have this looming bond debt and bond payment that they're going to have to make, and most debt is denominated in dollars, so they're going to have to buy these dollars. I do still think that that is still in play. I mean, we shall see. And again, I'm not trying to predict the future. I'm just anticipating what could be, just like any good chess player would. No chess player can fully predict what their opponent is going to do, but they can think 5 or 6 moves ahead. They can anticipate, right? That's what we're doing right now. We're just anticipating what could happen. Okay, I definitely think that's a very good possibility that happens, and I'm positioned as such with those hedges. Okay, so that's the dollar. We talked about crude for a bit. Oil, crude is, now negative for the year. Let's look at natural gas. There's a lot of interest in natural gas. I've been talking about natural gas for a while too. I'm getting very bullish myself. We shall see. We made a huge reversal yesterday. Nat gas was down, but then it went way up, like I think it was like 7 or 8%, which is crazy. Okay, and so at least on the daily chart, it does look like it's making a higher low. Let's actually look at a weekly chart. Weekly chart. Yeah, so we still have today and tomorrow, and if it makes this, like, if it gets green by the end of the week, I mean, that looks like an exhaustion signal, does it not? If you look at the European contract, the European natural gas contract, I mean, this is even more bullish looking. Okay. There is this cold snap. Everybody was talking about a milder than expected winter in Europe, like from months ago. Like, how do you know? Like, how would you know what the winter is going to be like? Okay. And everybody thought, oh, it's going to be a wild winter, a mild winter. November, is warmer than expected. Well, the coldest months actually, that cold snap usually in Europe starts, if you look through, statistics. I was just looking through the climate reports, and it looks like, it's like usually the cold snap happens from mid-December, all the way to February. So we're just getting started. Okay. We're not even there yet. So it could get colder. Then what? Okay. Then what? And if those storage, if the natural gas storage starts dwindling down in Europe, then what? I mean, this is going to go really up. Okay. That could send the euro currency down. That could send the Euro Stoxx down. We still have our FEZ position. Our FEZ position right now is a little bit underwater here. But it's partially a hedge, a negative delta hedge for me as well too. My FEZ, as you guys know, are dated for February, just in case, so you guys have peace of mind. I still am in those February puts, those 36 puts. So we'll see. We'll see what happens. But nat gas, at least in the Euronext, the Eurex futures exchange, it does look like it's going up and up. On a weekly chart, it is making that higher high, higher low, and it's still climbing forward. So we'll see what happens with nat gas. I do want to get into some nat gas names, but right now, a lot of the nat gas names have a large correlation with oil companies as well too. Whenever oil stocks sell off, usually these natural gas stocks sell off too. So they, they're kind of correlated, and so that's the only reason why I'm a little bit hesitant, because I think oil could, it could end up going a little bit lower. So if we do see that opportunity, though, I will take it. One of the names that I'm looking at that produces a good amount of natural gas over oil is CPG. They actually do both. They do both the oil and gas, but I think they're more than 50%. Comes from natural gas, though. So this is a name that I want to get into. It's more of a smaller hydrocarbon play. The market cap is, I think, only like about, maybe 1 to 2 billion or something like that. It's a much smaller company, but they are buying back their stock. All right. They have an aggressive share buyback program. They're increasing their dividend. They actually also had a special dividend this year and last year, I think. One of those years they had a special dividend. Their earnings are going up. Their free cash flow is going up. They have a plan to return value to shareholders. That's a great story right now. So CP CPG, you know, I may start nibbling in some shares if it gets to around $6 or so. You know, we're about 10-11% away from that. If I see this further drop, I definitely want to get involved in this. You know, I might start selling puts first on this for assignment, you know, and try to get a little bit of yield out of this first. That may be the move. But again, I will know more probably around January. You know, with that OPEC meeting coming up, we'll probably, you know, we'll see what the market positioning is in the oil and nat gas markets, and then we'll try to make a play on this. But again, that $6 zone is what I'm looking at for CPG. I think we get there. Especially if we see more downside in oil, which is definitely a possibility here. Precious metals, the dollar, you know, as dollars coming down, we're seeing precious metals rally a little bit. Too bad for us, we're not in SILJ or GDX or any of those miners that we've been talking about for months now. We just never had that big enough pullback to get in. But if you look at gold right now, I mean, you know, it's just marching forward as the dollar comes down. Gold is going forward. I'd really like to see gold, you know, if the dollar goes up, I do want to see gold coming down and silver coming down, all these metals coming down. And at that point, that's when I really want to strike and get into SILJ or silver miners or GDX or something like that. You know, I want to get into some leaps that are, you know, January 2024, January 2025, at least a year out in the money, 65 to 75 delta, and sell shorter dated out the money calls. That's a poor man's covered call, and that's what I want to be doing with SILJ and all these metal miners. But we need to see a big enough pullback, and hopefully if the dollar gets its act together and retraces some of those, retraces its breakdown for the last few weeks, maybe we get a little bit of a pullback in some of these metals, metal miners, and, you know, the actual metal futures prices, so that we can get into some of these names. But I'm still planning on doing that as well too. Okay, this is still part of the plan. All right. Anything else you guys want to look at? Anything else, guys? So again, patience is key. Next week we're gonna have this, you know, these big meetings, or big events. We're gonna have the CPI report. We're gonna have FOMC. I think it's best to sit tight until then and see what the market does. You know, and the market reaction to an FOMC is not always that same day. When the FOMC comes out, the rest of the world is asleep. Asia's closed, Europe is closed. So sometimes we don't see a reaction until the next day or the day after. Even sometimes it takes all the way to the following Monday in order for us to see that move, that reaction. Okay. So it really depends on what happens, you know, afterwards. But I think, you know, the market's going to give us a little bit more of a direction on which way it wants to go for the end of the year after all of that. Okay. I think there's a lot of just hedging, a lot of chopping back and forth, probably a lot of like tax selling happening between now and then. So you might see some weird chop heading into FOMC for the rest of this week into next week. Okay. And we talked about that a lot yesterday. I'll put some links up here. If you click on the exclamation point on the top right, I'll put some links where we talked about all of this. Okay. Oh, crypto. I know you guys like to talk about crypto. Some of you guys exclusively, you know, trade crypto, Bitcoin and Ethereum and such. It is looking like you know, there's a little bit of gain. We're just chopping around this level right here. This is our kind of like our this is a very important zone for us from this summer. And it's kind of just chopping around there at this moment. Right now, we're a little bit above it. It does look like, at least on a daily chart, it is looking like it's wanting to make that higher high, higher low. So maybe we see an uptrend in the crypto space. Which again, I mean, I'm positioned, at least for my hedging, for a dollar spike. And if the dollar spikes, anything priced in dollars is going to come down. And I think Ethereum, Bitcoin, I mean, if the dollar spikes, it's going to come back down again. But I mean, we'll see. I mean, Well, we'll see. I mean, I could be wrong. Who knows? All right. Bitcoin, same thing. My plan still hasn't changed. I'm waiting for that ETH to gold ratio line. I don't know if we're ever going to get there. It teased it almost. You know, it wasn't that much. I mean, if gold had kind of stayed where it was, and if Ethereum had dropped like another I don't know, 10, 15%. And at the time, Ethereum was dropping like 10, 15% in a day. And if it did another one of those, it would have hit. It just needed like 1 or 2 more days of that selling to hit that line, but it never did. Could we have missed that opportunity? We might have. But there's always another trade in the future. There's always an abundance of opportunities. You know, the mindset of the wealthy is that there's always an abundance of opportunities as long as we know where to look. The poor mindset is that opportunities are scarce, so we got to jump in at every opportunity. You know, that's not the best way to trade. That's usually how you lose a lot of money in the market. You always want to have that mindset of abundance, the mindset of wealth. There's always an abundance of opportunities. There's always another trade. There's always tomorrow. Okay, so keep that in mind. Patience and discipline are 2 of your best friends in this business. Anything else, guys? Anything else you guys want to look at? Going once, going twice. All right, well, that wraps up then our session of the Morning Market Memo. Our Discord invitation link is in the description below. Come join our Discord, be a part of our growing community. There's no sub fees, no paywalls. It's of the people, by the people, for the people. If you enjoyed our video, hit like, follow, subscribe, comment, show us some love, baby. All right, I'm going to be back next week, Tuesday, Wednesday, Thursday, 10 a.m. Eastern time, 30 minutes after the opening bell of the New York Stock Exchange. I hope to see you guys then. And I'll hang around in the Discord for a bit, answer any questions, and post some charts. And then we'll go from there. All right, guys. Have a wonderful day. Trade safe.